Hi, I'm Nick Balkin from Foord Asset Management, and today I'm going to give you an update for the third quarter 2023 for the Nedgroup Stable Fund. As you can see, the topic is stability through diversification, and we've always thought that diversification is the only free lunch that you actually get in markets. And I think it is a time that you need diversification, in my opinion, especially now. I think the third quarter, I would say, is a very tough period to be reporting on a quarter-by-quarter basis. If you look at it, the different asset classes have all, unfortunately, had a negative performance. And that's as a result of the overall debt crisis that we speak about at quite a few of our meetings that we've done recently. What that effectively means is the 10-year bond, which is the risk-free rate that the global asset classes price off, has moved up significantly. Only 3 years ago, you saw that the risk-free rate was around 0.5%. That's now moved up to almost 5%. That's a huge increase for the risk-free rate. That not only affects the bond prices, but that also affects the equity prices, unfortunately. So overall, the quarter did suffer from that. As you can see from the top of the slide, the inflation has remained sticky. Yes, it's come down. We continue to think at Foord that although base effect will mean that inflation does come down slightly, it also means that, at least from our opinion, that inflation will be slightly higher than people think over time. This combination with the supply that's coming through of the US debt is really creating a problem for the overall long-term bonds. And as you can see there, that's effectively repriced all the different asset classes, which meant that global equities was unfortunately down for the quarter. Global emerging market equities were also down for the quarter. Even bonds were down for the quarter. So it really, on a quarter-by-quarter basis, it wasn't a great time. The combination, as it says there, with oil, unfortunately, also surging. Oil is a headwind for most countries because it's an input into pretty much anything that people do, whether they drive and it takes money away from the consumer, whether it's an input into something that a manufacturer is using for inflation. So generally, that really acted as a headwind for a lot of economies also. And then you can see, obviously, that when, yes, long-term, there might be de-dollarization, but when there's a really tough time, the dollar does tend to outperform. So all in all, I'd say a tougher quarter. I think where did the performance come from? You can see from the kind of, and I like to do it from a contribution point of view, which, as you can see from this table, you can see that these are not attributions. These are the actual returns that you can get from the different asset classes on the stable fund. On a 3-month basis, the biggest attractor was the foreign assets. That is as a result of the underperformance of equities, but also the, underperformance of our global equity fund, which is a building block. On a year-to-date basis, on a 1-year basis, it's absolutely a different story. There's huge alpha and there's good performance across a lot of the different asset classes. You can see on a 1-year basis, the contributions were quite positive from global equities, and the contribution from even our bonds and our foreign were very positive. So I think, like with anything, on a quarter-by-quarter basis, you get the impact of, noise that I spoke about. But I think longer term, 1 year, it definitely does, take out some of the noise. From an average weight perspective, you can see that in that period, we had around 42% of our portfolio in the offshore funds, which obviously, as I said, played a role also when they're down and you have quite a big weight to them. Interestingly enough, on the quarter, you can see that the bonds actually outperformed. We have a 0.1 positive contribution, even though that the ALB was negative. So it was good positioning on a quarter basis, actually, for the overall bond section. Yeah, just one more thing. I think I've spoken a lot about it, but just on a 1-year basis, the overall portfolio did very well at 11.5% up, handsomely beating inflation. Long-term, still quite ahead of inflation, and even year-to-date, still a very good number. So how do we think about it? I thought, as I said, the theme of the presentation, in my mind, is just the debt issues that the world is having to deal with. I think it's still underappreciated. It's definitely getting more news time. If I ask the layman, they would understand that the S&P probably did downgrade the US debt. So I do think it is becoming a little bit more mainstream, but the technical side of it, I think people aren't really that ready for. And I think this chart, to me, is a great way of explaining the overall impact of the budget deficit in the US. And as you can see, the budget deficit is hitting way over 6%. Yes, it does have some one-offs from the student income side of things, but structurally we think that the US economy is facing a 6% deficit. And the crazy part of it is that it's a 10-year bull market. So what tends to happen through the cycles, as you can see on this chart, is that when you have a tough time, the government is able to spend their way out of a recession because they re-stimulate people that I guess are feeling very conservative when there's a recession. Unfortunately, we're entering this, I guess, tougher time with a budget deficit of 6%. There's no room for the US government to continue to stimulate the overall economy. So I think that's one of the bigger issues for me, is that you really are entering a point where there's no such ability to stimulate the overall economy. So putting it together, this is the risk-free rate of the overall economy, or the US economy. You can see just 3 years ago, it was 0.5%. That's obviously around COVID and things that happened. But I think people got used to it. You can see that the 5% is actually not unnatural relative to the long term. You can see the early 2000s, the US 10-year was around about that number. So this is not unprecedented. Some people see the 5% and they think, wow, that's a very high number. Is it sustainable? Well, in our minds, given all the supply issues, there's a real chance that, I guess, the bond vigilantes, there's a word that people haven't heard for a while. Bond vigilantes are effectively the bond investors that are looking at the debt and saying that I don't want to buy this thing and I'm going to attack the bonds because they're underpriced. They've come back to the fore, and I think it's something that we should probably get used to, actually. I think people are saying it's very high and it's going to come down again. I think the problem is actually what happens if it stays high for longer than people expect. So this is a drawdown chart. It's quite hard for people to comprehend just when I kind of show the chart. So I won't explain it kind of in detail, but basically from the performance that you see at the top, a drawdown is effectively any decrease in the price of a bond, or the overall US aggregate bond index from its highs down to the low point before it kind of bounces back. This chart shows you the volatility of the overall bonds. As you can see that the really big drawdown that we've seen now is unprecedented in modern history. You can look at the 70s and 80s as a kind of guiding light, but the biggest drawdown is actually now. People don't really understand how big an impact this has been for the bond market. If you take the overall US 30-year bond, that's quite a long duration bond. Anyone that's invested in that 30-year bond over a 1-year basis has actually led to an almost 50% decline in the overall principal or investment that they made. So that's a huge number. And sometimes people struggle to comprehend the risk of investing in a long duration bond. And I would guess everyone calls it the risk-free rate. But actually, when you think about it, losing 50% of your money on a 30-year bond is pretty risky to me. So everyone who says that they're risk-free, I guess they do come with a caveat that you can lose money, especially over a short period of time. I think one of the biggest questions we always get is it hasn't come through into the real economy, meaning why has the US economy continued to grow? The 10 years up, equity markets are showing volatility, people are losing money on the bond side of things. But why is the US consumer, why is the US economy not falling over? So a large part of it is that most people have their mortgages fixed, meaning that their consumption and their disposable income still is very strong. But what this chart shows you is actually not for the future buyers of mortgages. You can see that the mortgage rate for anyone who's coming into the market right now has jumped substantially. Almost the interest rate has doubled over the period. So you can see it was almost 3.5%. It's heading towards 7.5%, which means that anyone who's buying a new house in the US cannot afford it. So it's going to be a really slow bleed, but actually it's going to be a really big issue for the overall US economy into the future. So I would caution that the impact is yet to be felt, but absolutely looking forward, it's coming. There's almost a certainty in my mind, as the future is never certain, but this is a high probability event that the US economy is going to face many headwinds, one of them being the mortgage rate in the US that the consumers will have to face. I think turning to South Africa, I guess, since this whole theme is about debt and about how debt impacts economies, just like America, South Africa has the same issue. I think I've spoken about this quite a few times, but I think it's worth reiterating. The debt in South Africa is getting to unsustainable levels. The window of opportunity for the South African economy to bring it back is closing. When 20% of your total tax take is going towards just paying back the interest, that's a huge burden for any economy to spend. Even if you get to something called the primary budget surplus, which means effectively that we are taking in more taxes than we're spending. More than 5% of the GDP that we have right now is just going to pay interest. So that everyone knows the story, and I've said this ad nauseum, but I think it's worth reiterating. If you're spending more than you earn, eventually the interest income will overburden the total, even if you start tightening your belt. And I think that's the case, I guess, in the South African economy. So what are we doing about it? I think the problem for us is that the market continues to ignore a lot of the things. Yes, the quarter has come down. We think inflation is still going to be more sticky than people expect. We don't think that this higher inflation, higher yield world has been priced into global equities. This has obvious implications for overall markets. We also think that people aren't kind of pricing in any credit crunch. So we think those sorts of things mean that the opportunity cost of being too bullish means you make a little bit of money, but actually if something kind of plays out the way I'm talking about, it could be really tough for overall economies. And that's why I think that diversification that I spoke about at the beginning is the most important thing to be doing. So what do we do about it? It doesn't help that it just says, okay, everyone, the world is not feeling very well, and I'm sorry about that. I think that the good part is in the stable fund, there are many things that we can be doing. The first thing that we can be doing is looking for opportunities where there's lower downside, but almost as much upside, maybe not the most upside, but actually we're balancing that downside and upside. So as you can see from the chart, the inflation-linked bonds is really an appropriate place for us to spend our marginal money because it's a very good risk-reward investment. What this means on this chart is now the real rate that you get over and above inflation when you buy an inflation-linked bond is almost 4.5%. For us, that means that you can lock in whatever inflation is plus 4.5%. The downside is if inflation is slightly lower, yes, the return will come down a bit, but the eventual outcome is that we have locked in the 4.5%. So we think that's a very good way to deal with the risk reward of all the risks that I spoke about previously, including, say, a rand blowing out and hyperinflation in South Africa. Those are low probability events, but we have absolutely protected that side of it. Also importantly, the gold. I've spoken about it a lot. I like to reiterate it. Gold is a great way for us to have an insurance policy. Some people say the cost of the insurance has gone up, and I'd agree with that. But absolutely, when tough times come, you absolutely want things that are uncorrelated with the market. If the market goes down, hopefully gold goes up and provides a nice safety net for the overall portfolio. So just in closing, what did we do? How did we deal with the portfolio? I've spoken about some of the things like the inflation-linked bonds. Overall bonds over the year has absolutely come down from almost 30% of the portfolio to close on 25%. Inside that bonds, not only have bonds come down, but the fixed coupon bonds have come down even more as we've started adding more and more inflation-linked bonds. So that would mean that the fixed coupon bonds have compressed even more. Overall, naturally, given where the rand is, you can see that the overall foreign component has gone up to almost the maximum at 45%. It is as a result of I guess, the performance that I showed on the previous slide at the beginning, where it showed the contribution of foreign doing really well. So it's grown as a result of that. But also you can see that it's, I guess, where the opportunities in our mind are. I think the last point is to show that this does have an element of equities in the fund. It will add some volatility. It's just on 35% of the overall fund is in equities. So I think it's a very well-balanced fund. As you can see, we've got some bonds, we've got foreign, we've got a bit of equities, and we've got the gold as a countervailing force, which is important because I do think we're heading into a tougher time. I do think the right time for us to be aggressive is not now. The right time to be conservative and making sure that we have different drivers for where the world can go is now. And I think that gives us a looking forward that we're confident that even if we do have a tougher time, we're well positioned for that. I thank you for listening to the third quarter update, and I'll see you soon in the fourth quarter update. Bye, everyone.